The last time this happened, lots of regular people became millionaires. March 2020. The world stopped. Offices went dark. Hotels stood empty. And the smart money said real estate was finished. Most people saw a nightmare, but a small group of people saw a receipt. They saw a moment where fear erased logic, where prices fell 40% overnight, where the banks were too terrified to lend. And they got rich. Not just rich. Life-changing, quit-your-job, multi-generational wealthy. That was 5 years ago. Most people are still kicking themselves for missing it. But here's the truth they don't want you to know. The last time this happened, regular people became millionaires. And if you look at the data from the last 30 days, we are living through the exact same setup. Right now, most people don't realize we're living through something similar right now because it doesn't look like a crash. It looks like a story about offices, about remote work, about debt. But if you know what to look for, this is the single biggest wealth transfer of the 2020s. Stay with me. Here is the headline nobody is screaming loud enough. $2.7 trillion. That is the wall of commercial real estate debt coming due before the end of 2027. And the banks, the big, scary, too big to fail banks, they don't want these buildings back. They can't afford to take them back. Here's a core concept. The thing that changes your life. Wealth isn't created when the economy is booming. Wealth is transferred when the economy is breaking. When everyone is terrified, assets don't lose their value. They lose their price tag. Right now, we are in the snapback zone. The last time we saw a force selling like this, 2011, 2020. Regular people who bought apartments, storage units, even small retail strips, they didn't just double their money. They 5x'd it, 10x'd it. This window is closing, not because the news says so, because the math says so. And this changes everything. Let's go back, not to 2008, further, to 1991, the savings and loan crisis. Banks collapsed. Commercial real estate fell 65% in some cities. A guy named Sam Zell bought office buildings for 10 cents on the dollar. People called him crazy. They said, work from home is over. Wait, sound familiar? He held for 5 years. Sold for $400 million. He didn't invent the opportunity. He just had cash when nobody else did. The hangover from 2008. Regional malls were dying. Amazon was the villain. Everyone said retail was dead. But a small group of investors, teachers, nurses, software engineers who read one book, they bought those strip malls. Why? Because the math was stupid. A strip mall cost $2 million. It was generating $200K in rent. That's a 10% cap rate. P10. By 2018, those same malls were worth $5 million. The rent had doubled. Ordinary people who put in $50K walked away with $250K. This isn't a story about hedge funds. This is a story about a single mom in Ohio who bought a dollar store property in 2011 because the price was lower than the cost to build it. She retired at 52. The pattern is always the same. Crisis, panic, forced selling. Then the snapback. We're in the panic phase right now. And most people are watching Netflix. Let's put our emotions aside. Let's look at the institutions. BlackRock controls $10 trillion. In their 2025 outlook, they said, and I quote, "The repricing in commercial real estate is the most significant dislocation since the global financial crisis. Office vacancies are near 20%. In San Francisco, it's almost 35%. That is terrifying. But here is where most people get it wrong. The media bundles all real estate together. Commercial real estate is crashing. That's like saying the stock market is crashing because one biotech stock went to zero. Warehouses, data centers, self-storage, medical offices. These asset classes are up, not down. But because offices are the headline, the fear bleeds over. According to TREP, delinquency rates on commercial mortgage-backed securities just hit 8%. That is a 300% increase from 2 years ago. Here's the big one. The Fed cut rates in late 2024. That is the spark. When rates drop, cap rates compress. That means asset prices go up. We have a situation where prices are still low because of panic. But the cost of borrowing is dropping. That is the arbitrage. That is the window. So if the math is so clear, why isn't everyone doing this? The problem isn't a lack of opportunity. It's how people react to it. There's a psychological trap. I call it the office building fallacy. You see a headline, downtown office sells for 70% loss. Your brain triggers fear. You think, real estate is dead. But the investor, the one who gets rich, thinks differently. They ask, who is being forced to sell and why? Most sellers right now aren't selling because they want to. They're selling because the bank is calling their loan or their fund is facing redemptions. They are foresellers. The wealthy don't ignore fear. They monetize it. When you see a 40% discount, the rational response isn't fear. It's curiosity. What is the actual cash flow? Because if the cash flow covers a mortgage at 6% interest and interest rates are about to go to 5%, that building just became a gold mine. The second psychological killer is distraction. We are living through the most distracted era in history. While you are watching a 3-hour drama about a lawyer, the window is closing. The opportunity doesn't wait for you to feel comfortable. So let's get specific. Where's the money? Not downtown San Francisco. Not Manhattan skyscrapers. The opportunity is in the Sun Belt, secondary markets. Nashville, Charlotte, Tampa, Austin. People are moving there. Businesses are moving there. But the real estate prices haven't caught up yet. 3 asset classes. Boring. Unsexy. Profitable. Number 1, self-storage. Americans pay $40 billion a year to store their junk. Self-storage has a 92% occupancy rate. It's recession-proof. And right now, small storage facilities are trading at 2019 prices. Number 2, mobile home parks. Warren Buffett is in them. Why? Because when housing is unaffordable, people don't stop needing a place to live. They just rent the land. The margins are 50%. Number 3, medical offices. Baby boomers are aging. You cannot do a Zoom call for a knee replacement. Medical office rents are sticky. Leases are 10 years long, and lenders love them. Here's a ripple effect. When smart money buys these assets at a discount, they renovate. They raise rents. Property values go up. Tax assessments go up. Jobs are created. Contractors get paid. Local economies stabilize. This isn't Wall Street extraction. This is Main Street compounding. The barrier to entry is lower than you think. You don't need $5 million. You need a self-directed IRA, a syndication deal, or a REIT that focuses on distressed assets. And you need to act while the banks are still scared. Strategy. No fluff. Actionable steps. Step 1, raise liquidity. Now, the opportunity arrives without warning. If your money is locked in a 401k or a volatile stock, you can't move. I want you to have $10,000 to $20,000 in a high-yield savings account. Dry powder. Ready to deploy. Step 2, learn the cap rate. Capitalization rate. Net operating income divided by purchase price. If a building makes $100,000 a year and costs $1,000,000, that's a 10% cap rate. In a panic, you can find 10% caps. In a stable market, you get 5%. If you buy at a 10% cap and rates drop, that asset becomes a 12% cash-on-cash return overnight. Step 3, syndications. You don't buy the building. You buy a piece of the LLC. Platforms like CrowdStreet Realty Mogul or local investor groups. Put in $25,000. Get preferred returns. Get a piece of the upside when they sell in 5 years. Step 4, mindset shift. Stop asking, is it safe? Start asking, what is a margin of safety? If a property is selling for less than the cost to replace it, that is a margin of safety. You are not gambling. You are arbitraging human emotion. Let's make this real. With numbers. Meet Sarah, 35 years old. Teacher. She has $15,000 saved. In 2025, she invests in a syndication buying a self-storage facility in a growing Texas suburb. Purchase price for $1 million. She owns 0.5%. Cap rate at purchase, 8.5%. Cash flow year 1, $1,275. Not life-changing. Not life-changing. By year 3, The sponsor raises rents 15%. The property is now worth $5.6 million. They refinance. Sarah gets a return of capital for $1,500. By year 5, they sell. Sales price, $6.8 million. Sarah's share profit, $22,000. Plus her cash flow, $8,000. Total return on $15,000, $30,000. Now compare Mark. Same age, same income. Mark saw the headlines in 2025. He said, too risky. He left his $15,000 in a savings account at 4%. After 5 years, Mark has $18,000. Sarah has $45,000. Now do that again. Year 6, Sarah rolls her $45,000 into a medical office deal, then a mobile home park. By age 50, Sarah isn't teaching anymore. She's consulting. By choice. The difference isn't intelligence. It's the decision to participate in the transfer. I need to be honest with you, because the YouTube algorithm loves hype, but I love you keeping your money. I need to be honest with you, because the YouTube algorithm loves hype, but I love you keeping your money. This will not feel easy. There will be a day, probably next month, where a headline says commercial real estate collapse worsens. Your self-storage REIT will drop 15% in a week. You will feel sick. That is the test. That is the filter. The people who panic sell in 2025 will be the ones watching the documentary in 2030 saying, I should have held. Fear transfers well from the impatient to the patient. Point 35. The fundamentals don't care about your feelings. If the rent is being paid, the asset is fine. You have to zoom out. This is a 5-year play, not a 5-week play. If you can't handle a 20% paper loss without sleeping, this isn't for you. But if you can look at a discount and say, thank you for the sale, you will win. Remember the woman at the beginning? The one who bought during the 2020 crash while everyone else cried? Her name is Lisa. She was a dental hygienist. She had $40,000 saved from 10 years of skipping vacations. In April 2020, she bought a small suburban medical office building for $350,000. The previous owner was leveraged to the teeth, and the bank gave him 48 hours. She put down $35,000. She rented it to a physiotherapy group. They never missed a payment. By 2025, that building was worth $720,000. She sold it, paid off the mortgage, and walked away with over $400,000. She is not a genius. She is not a Wall Street insider. She just knew that when everyone else is running for the exit, that is exactly the moment you walk in. You now know what's happening. The debt wall, the forced selling, the cap rate dislocation, the rate cuts. The last time this happened, regular people became millionaires. It is happening again. The only question is what you do next.